Hello and welcome to today's webinar hosted by Market Matters. My name is James Gerrish. I'm the author of Market Matters, the portfolio manager at Market Matters, and I'm also the portfolio manager at Uranium Partners. I'm thrilled to have so many Market Matters subscribers on the webinar today. We're going to be focusing on commodities. I've got two very strong, exceptional analysts that I lean on pretty heavily on the call today, which I'm going to introduce in just a second. Before I begin, it's great to have, as I said, it's great to have so many Market Matters subscribers on the call today. We've also opened this webinar up to some who don't subscribe to Market Matters, and the whole reason for that, the primary intention is to entice you to subscribe to Market Matters. We're a daily market report. We run real portfolios. We deliver what we feel is real market intel. So if you're not a subscriber, you can do so by visiting the website. You can email our sales team at info@marketmatters.com.au, or you can call the 1300 number that is available on the website. As I said, today's webinar is focused smack on commodities. There's so much going on in the space, and I'm thrilled to have two analysts that I lean on very heavily here at Uranium Partners joining me on the call today. I'll bring in Peter O'Connor. I think you've just got to unmute yourself there, Peter, and turn your video on. I've got Peter O'Connor, who's very familiar to Market Matters subscribers. Peter's been on a number of videos with us and presented. So Peter's along for the ride here in Sydney. I believe you are, and now we've got Michael Clark, who's one of our really good analysts down in Melbourne, joining me. So Michael is going to unmute and turn his camera on, which he's just done. So welcome to both of you guys. Thanks for joining us and spending the time.
Thanks, James. Good to be here.
Thanks, James. Thanks for the introduction.
Great, thanks, Michael. So just before we begin, just a little bit of housekeeping. I just want to remind everyone that this is a general advice only, so you shouldn't consider this to be personal advice, and you should consult a financial professional before taking on the advice. Today's going to be a chat about the commodity space and specific parts in the commodity space. I'm going to break up this webinar into two distinct parts, mainly around what's hot. So we've got energy markets, oil, coal, uranium, etc. It's hot right now. We've also got areas that are not quite so hot at this point in time. So I think that's a pretty encouraging way to break this today's webinar up. It's going to be a chat, so I'm going to go off this screen in just one second and turn over to the guys. And I'm going to start with Michael. So just to give you a brief introduction of Michael. Michael hasn't been on many videos for Market Matters, but he did do one deep dive podcast into Paladin, and Paladin Energy was trading around 40 cents per time. You began covering it earlier than that, but it was one of the interesting deep dive podcasts that we did, and you articulated a really clear path for uranium and Paladin Energy in particular, and a number of the other juniors in the space. So it's been a great call. It was at 40 cents at the time. It's traded above $1. It's on the skids again today. But we're going to get your views around Paladin, as well as other areas in the market. Oil's obviously the main place to start in terms of energy, Clarky. It's been hugely strong. We've had a month of really solid gains in the oil price. Is it justified, and can it continue?
Yeah, there's been some really big moves, James, and thanks for the introduction. The energy sector, like in Australia especially, it's sort of struggled to catch a bid with the big names, sort of Woodside and Santos this year. They've lagged their sort of global competitors. But the big picture is the world is hurtling towards an energy crisis, and it's one in which the demand for oil, gas, and coal, it's continuing to increase on a 3 to 5 year view, maybe longer. So oil, coal, and gas are responsible for 31, 27, and 25% of energy end use, which added up, that's about 83% of the total energy mix. So the global supply chain, it can no longer adequately respond to the stringent, the reason is the stringent environmental, social, and governance regulations, and there's a lot of pressure from investors. So there's a fear of peak demand, and then that's leading to the reality of a lack of supply and all-time high fossil fuel prices. So for instance, right now we're seeing this in some of the European gas benchmarks, coal and LNG. So North Asian spot LNG right now is about $40 per MMBTU. So that corresponds as an oil price to $230 a barrel. And Brent oil, which is the main oil benchmark, that's trading about $80 a barrel. So, you know, it's significantly higher than the energy equivalent oil price. And these high prices, despite there's a decades-long runway for substitutes needed to reach critical mass and achieve decarbonisation. So we actually upgraded our energy sector view in mid-May to overweight, and we want to just reiterate the call now. Oil fundamentals, they look really robust, I think, and inventories are being drawn down. You're seeing this in OECD commercial inventories and US inventories. They're below the 5-year range, 2015 to 2019. And over the past 18 months on oil markets, there's been a 90% recovery in demand to pre-COVID levels, and consensus expectations that we're going to be at pre-COVID levels next year, so 100 million barrels a day. And on the supply side, just quickly going through the two swing producers, US shale and OPEC plus. I think US shale is flatlined and OPEC plus is struggling to ramp up right now. So demand is improving and more supply is required, and price is just going to be the clearing mechanism in that environment. So it's an incentive price environment to incentivize producers back into the market. And that's by definition above cost curve support, which we think that's sort of mid-cycle pricing. We think that's $70 a barrel. So current prices are what they are, and I think they're going one way on a 12-month view. I don't think it's too late to be buying the sector. And you know, the fundamentals, as I said, all demand is improving. US shale supply has flatlined, and OPEC doesn't have the firepower on a 12-month.
So basically, what you just alluded to there's a real lack of investment going into the ground in this space to sort of offset the natural depletion that happens in oil markets around the world. You've got a situation where economies have gone from being weak and oil demand being weak to now being strong and oil demand picking up, and that supply side is not keeping up with the demand side. We all get the concept of decarbonisation and the long runway that alternatives are going to play in that space, but it is a long runway and it is a long-term thematic. And in this shorter term, that lack of investment is going to lead to reduced supply and high prices.
Absolutely. You know, you just play the cycle, James. You don't, I don't think you try and fight it, and you don't want to be trying to sort of figure out exactly where the world's going to be 5-7 years from now. Fundamentals look really good for oil on a 12-month view, on a sort of 2-year view. And, you know, the sector is sort of pricing in, you know, the equities are pricing in oil sort of in the low to mid 60s a barrel, and spots at $80 a barrel, and it's looking like it's going to go higher. So I think you don't try to overcomplicate it too much. And as I said, fossil fuels are at 80 to 85% of the global energy mix right now. And there's going to be a period of time before you get that mass adoption of sort of EVs and the like. So definitely for the moment, I think there's a good value play in the sector.
So I mean, one of the things that Peter O'Connor, Rocky, continues to remind us on these videos is around, you get the underlying commodity price right, you go a long way of getting the underlying equity trajectory right. So, you know, oil prices are bullish, which is, you know, bullish for the sector. We hold Santos in the space, you know, growth portfolio. They're obviously in a takeover a situation with Oil Search. We hold Exxon, you know, in a national portfolio, and we've got a fuel ETF from Beta Shares in our a global ETF portfolio, which is an ETF which tracks global energy companies. So that's how we're playing the oil trade at the moment. Peter, there's another area that has been really strong in recent times, and that's coal. You know, this thematic around decarbonisation, you know, really has been heating up, as Clarkey alluded to. Why is coal rising in an environment where we're going to use less of it and ultimately try and use none of it?
James, I could put it to you that we're on a slippery slope to nowhere in coal over multiple decades. That could be out to 2030, 2040, or 2050. But we're going through a cyclical upturn, which has got a little bit of a structural twist as well. So to your point, the demand recovery post-COVID started in July last year, and that's taken us through to now. Now we've got an additional overlay, which is supply. Supply constraints are starting to be exacerbated, as Michael indicated, and that's giving us that demand pull through. We're also getting a supply tightness, and prices have been squeezed higher. So thermal coal prices used for power generation are now at more than 5 times in the last 15 months. They're up 100% in the last 3 months. They're now at all-time high levels, and that's reflecting those cyclical factors, some underlying supply constraints, which are more structural factors, but we're still on a trend lower over time. But right now, we're on this plateau period where we could see prices higher, particularly into the northern winter, for at least the next several quarters.
So what's the trade in this situation, Peter? We've obviously, you cover a number of coal stocks. How do we play? And is there more to go? Because you look at what Whitehaven, Coronado, and a few others have done. It's been pretty exceptional in terms of price appreciation. Is that, are we done there, or is there more to play out here?
James, as exceptional as they've looked so far, and Whitehaven, as a case in point, is up almost, I think, 5 or 6 times. But where they should be trading is key. So if you go back to the last cycle in 2018, all things equal, Whitehaven, Coronado, and New Hope, all the key coal plays in Australia would have been trading a multiple above this. So Whitehaven should be $7. It probably should be closer to $9, all things being equal. So we haven't yet had that full pricing. Probably that's because of ESG headwinds Mike talked about, but there's also that disconnect. You mentioned that equities follow the commodity price. They haven't done that. There's been a decoupling, and that decoupling suggests we still haven't seen the upside yet. So coal prices and coal equities in particular, moving higher still from here.
Yeah, it was interesting. We had a call a couple of weeks ago with Whitehaven's MD, and it's the first time, we've seen calls over the year that have been challenging due to operational issues, due to financial constraints, balance sheet, etc. But I've never seen him, and I think you made the comment on the call that you've never seen him so relaxed and comfortable in the environment that they're in at the moment.
It's amazing what a tailwind of price can do. It does wash over some of the operational issues, although they're getting on top of those, which is important. But what it does is it generates free cash, and it's the build of free cash is significant, and it creates deleveraging opportunities. So the companies that have balance sheets with leverage, Whitehaven, Coronado, New Hope, it allows them to deliver. And in the case of Whitehaven, the speed at which they can deliver, going from being a very indebted company, June last year, the market calling for an equity raise because they didn't have enough cash, to a point where they can retire their entire debt position in a half a year. It's extraordinary. So that's true across the sector. His confidence was driven by that cash flow that's coming in, and because of lags in prices, they haven't even started to get the prices we're seeing today. They've got a 3-month lag, so a lot of cash coming in the door, which translates to deleveraging, but also to capital returns to shareholders as well. That'll come next.
All right, so Whitehaven coal and coal stocks stay along there. Clarkey, uranium is a risky area of the market. I touched on it before, that this was one of your top calls a while ago. It's up multiple times from when you initiated on it. From when we've held it, we bought Paladin in the space in the mid 40s. We did tick it out around 95, but we're back in around the 70 mark now. What's your bigger picture thesis around uranium and the stocks that are listed on the ASX in particular?
Good going there, James, on playing the sector, trading it. Risky, as you said, that's a word I think you associate with the uranium sector, for better or worse. So uranium, as the listeners probably know, it's a mined heavy metal that's predominantly used as a feedstock for the nuclear power industry, and it forms about 10% of the world's electricity generation. So since Fukushima in 2011, there's been a lack of investment in uranium mines and the nuclear power sector. So there's been a 10-year cyclical downturn. And our message over the past 12 months is that the time has come for investors and uranium markets. They're starting to respond. The volatility in the sector since mid-August, that's all off the back of the Sprott Physical Uranium Trust, or SPUT, at the market facility commencing purchases of uranium. So since the facility was activated, spot uranium moved up about 65%, from $30 a pound to $50 a pound, and it's corrected a little bit in the past couple of weeks. It's back around sort of $40 a pound. But $50 a pound, that's 6-year highs. It's moved the price. So things are going on, and we're still positive the sector. We think it's a several year sort of thematic. We know it's moved up about 350% collectively since we initiated last year, which is unbelievable. But the thesis, it's based on a decade of underinvestment, and there's just so much. The thematic of decarbonisation and electrification, that's just a generational type thematic. So what we do with our uranium price deck is we include an upcycle to $85 a pound realised uranium, and that's for reinvestment in the sector to occur. Our long-term price assumption is $60 a pound, and that's where most sort of experts think that cost curve supports sit. And I think the sector still has a way to go. As you pointed out, probably now is a good time to be looking at the sector again. If you're sort of trying to pick an entry point, there's a bit of value that's emerged again.
So Paladin is the most liquid way to play uranium on the ASX. You mentioned the Sprott Physical Uranium Trust. You can buy that in the US now. That's a Canadian. You can also buy it in Canada. There's a global ex-uranium ETF under ticker codes listed in the US under URA. There's another way you can play it there. What are you like Paladin? What are some of the more specky ends of the uranium space? There's been some huge, like obviously watch the screen all day, every day. There's been some phenomenal moves in the uranium space, and I got to the realization that the market was pricing a lot higher uranium prices than were playing out, and day traders were involved, and that creates a huge amount of volatility. But it does have a longer term thematic, this trade. So the uranium trade generally. What are those real high risk, high return sort of stocks in the sector that you like?
Yeah, I know what you mean when you're sort of glued to the screen. There are days, it was a bit like in the market meltdown in March last year, how you just can't move from the screen. And like the uranium sector, there was some moves like 25% in a day, and it was just like, what's going on here? It was just nuts. And yeah, the sector got to a point where it was just like it was pricing in $90 a pound in perpetuity, and it just got a little bit excessive. But as you say, like Paladin is the top pick, our top pick in the sector. It's the quality and it's the most liquid name. And we talked about that.
What's it pricing in at these levels? I think Paladin's just dropped tick below 70 cents today. What's that? What price target have you got, and what are your what's it pricing in at the moment in terms of uranium prices?
Yeah, so Paladin at the moment, it's pricing in about $65 a pound on my modelling. So using our price deck, we've got a sort of 58, 59 cent valuation on the base business, and we use a multiplier to have our price target at $1, which is 1.7 times, and that's just to recognise that resource companies trade ahead of valuation support in multi-year up cycles, and you see that with the gold sector. You see analysts put 2 times multiples on stocks in sort of a gold up cycle. So this is a multiple of MPV for those out there who are interested. Yeah, exactly. So another stock I really like in the sector is Silex, which we picked up coverage of recently, and they've got a proprietary laser enrichment technology. So they're targeting the nuclear fuel sector as a whole and quantum computing. And that was set up in the late 1980s in Sonic Healthcare, and it was spun out in the mid 1990s to Sonic shareholders in specie. So as I said, it's a laser-based isotope separation technology useful for enrichment, be it nuclear power or silicon, for quantum computing. And it's a pretty complicated company to model, and the market's only just coming up to speed on them after death by 1,000 cuts over the past 10 years. So a few sort of skeletons in the closet there. But the easiest way to put the Silex investment thesis is when Paladin got to $1.10 a few weeks ago, it was a $3 billion market cap company. And last cycle in 2008, Paladin, if you net out their Langer Heinrich asset at 75%, they got to a $3.5 billion company. So they got about 80% of the way there so far this cycle. And Silex is about a $300 million market cap company. And last cycle, it got to a 1.8 billion market cap company. So back of the envelope, that's 20% of the way there. And there's nothing different about the Silex technology other than it's more developed now than last cycle. So, I think Silex looks super cheap compared to the rest of the sector, and a lot of institutions are still coming up the learning curve there. So that's one for your listeners to look out for.
What's your take on Boss Energy? You've just got a question here on that. Do you cover that, Clarky? I can't remember.
We cover Boss. So Boss, we have a buy on. We've got a 30-cent price target, a 20-cent valuation. So it's a bit less liquid than Paladin. So we're using a 1.5 valuation multiple to get our price target. Boss may be the first company to sign contracts in the Australian market the way they're going. They might do that this year. It's a restart operation. And it's in South Australia, so the jurisdiction advantages, that sort of amongst the investment community, there's a preference for Australia, US, Western jurisdictions for investing. So, that's where Boss has got a bit of a strategic advantage, because uranium is a geopolitically sensitive commodity. So, that also works in the way for some investors, and there's a bit of leverage there. I mean, they're talking about getting up to 2.5-3 million pounds production of uranium, and the global market's about 180 million pounds. So, you're getting towards 2% global supply. So there's still a bit of leverage there. So, yeah, we like it. We like the sector.
Alrighty, let's move on to what else is hot. So obviously battery metals, lithium, nickel, and even copper. And it was interesting to see a BHP come out, and this is a stock that you cover, Rocky, come out and talk about future-facing commodities. They're rejigging what the core pillars of their business is, the operations are at BHP going forward. You hosted it, Mike Clarkey, you hosted an institutional day on that very topic, so future-facing commodities. You mentioned Silex before. Is there any other interesting stuff in that future-facing commodities? It's a buzzword at the moment. We're all talking about it. Is there anything interesting you want to highlight there?
Yeah, it's all in the marketing, right? Like future-facing commodities. Exactly. Love it. As you say, BHP, they coined the phrase. So we hosted a seminar.
As good as Fortescue being a renewable energy company that also mines iron ore.
Yeah, you buy a ticket to heaven, Twiggy. But it's all good. So we hosted Jervois, Blackstone Minerals. They're two battery metals companies. Lepidico, lithium from lepidolite, which is slightly different. Lithium from spodumene, and American Pacific Borate.
Lepidico is an interesting one. It's got huge upside if they get it right.
Yeah, massive. Like, it's an alternate pathway for lithium from hard rock, and it's some guys that were, I suppose, clued up on the downstream, and they bought an upstream asset in Namibia for access to the mineral. So the value's not in the upstream so much, it's more in the smarts on the downstream, which is a change for Australian investors, which I'll talk about in a second. But so there was the American Pacific Borate as well on boron, which is one of those commodities that's you sort of don't know about, but it's used in a lot of the future-facing technologies. And Oz Potash, sulfate of potash, the premium form of potash, fertilizer, and Silex, as you said. So the commodities, they all relate to electrification, batteries, food security, decarbonisation, and the energy transition. And they're a lot more focused, like I was saying, on the downstream operations. And it's different from the historical sort of Australian resource company, the business model of digging up ore and just selling it to China. And Australian investors are pretty unfamiliar with this concept. So they're sort of grappling with how do you value these sorts of companies. A chemicals business typically trades on a much higher multiple than a mining business. If you're talking about enterprise value, which is just market capitalization plus net debt to earnings, EBITDA. So if you talk about a chemicals company, they often trade on like a 15 times EV EBITDA multiple. So some of the big lithium names listed in the US, SQM and Albemarle, that's what they've traded on for the past 10 years. Whereas BHP and Rio, they've traded on 6 to 7 times, 8 times EV EBITDA over the past 10 years. And the reason for the re-rate, I suppose, for the chemicals companies is they're less cyclical and they don't have a depleting resource, and they're sort of longer life assets than the mines. So Australian investors are sort of working out if there's a lot of value in the downstream, how do I attribute, how does that convert into a share price? And you've seen all the lithium miners in Australia re-rate significantly in the past 6 months off the back of that. But I don't think you've seen that in a lot of these other commodities as much.
So this is an area that I'm going to write about in Market Matters, so subscribers can be assured that we're going to keep across this space. I'm just conscious of getting Peter O'Connor in here because I know how much he likes to speak on videos, and he's been left on the sideline a little bit there with Clarkey stealing all of the thunder. Peter, there's an interesting play happening in Independence Group at the moment in Western areas. So we own Independence Group across our growth portfolio. We've held Western areas in the past. What's your take on these two areas? Obviously, Independence has gone from is now a future-facing commodity business, whereas they've sold their gold asset. Western areas is obviously in the nickel space. What's your take on those two plays, Pete?
James, there is the land grab globally at the moment for future-facing commodity deposits, be it nickel, cobalt, copper, lithium, etc. So, and part of that land grab is nickel. And within that, we see BHP and Andrew Forrest bidding for a company in Canada. And in the local landscape, we're seeing some deals play out as well. The most high-profile one is Independence Group looking at Western areas. Fascinating things about that. What is Independence Group doing? They're a nickel company with lithium, as you mentioned. The conventional wisdom is they've got this large nickel resource. Point is they don't. They've only got a 5.5-year life left in their Nova nickel business in Western Australia. Now, whilst they recently mopped up a small junior, which added another 1.5 years life, and whilst they'll likely mop up some more in that area, companies like Boadicea, Galileo, and Legend will be mopped up. Their future dated production in nickel, Independence needs something shorter term. Western Areas gives them that. So Western Areas is about to start. In fact, they just hit the ore body yesterday of their Odysseus mine located near BHP's operations in Western Australia. They've got an existing mine which is running down. They'll have production over the next couple of years, but they've got a new mine starting which takes them out into the late 2030s with nickel production. And importantly, it's of a nickel type which is a precursor to the battery market called nickel sulfide. So Western Areas provides Independence Group that longevity of production profile and allows them that feed. So that deal, it's in due diligence stage at the moment. We're in the 3rd of 4 weeks of due diligence. We should start seeing that come to a head in the next week or so. It'll come down to pricing and debate between the boards of the two companies. It's very likely going to be a script-based offer using Independence high-price paper you mentioned for Western Areas, which has been at a discount. The stock is already about 30% off its low, which was pre the talk by Independence Group. To get to fair value, which would be the minimum the board should give this company away for, it needs to be about $3.20 or $3.30. I think it's trading below $3 today. So Western Areas is one of the first companies that will go in Australia. And importantly, just 2 years ago, the equity market wasn't interested in Western Areas. They couldn't see this story. So sometimes corporates can see the value which equity investors can't. So equity investors now are coming along for the ride. And that's what's closing that gap. But Western Areas shouldn't have been trading at $2.40 just a month ago, but it's closed that gap partially. So we think the deal should get executed. It'll come down to egos and boards and CEOs, but it should get done. It makes sense.
So you're keen on both of those stocks in the space if we think longer term?
Yeah, look, I would. And if I was buying Western Areas today, if I had Western Areas, I think it's going to end up in Independence Group via paper. So I get capital gains tax rollover relief. And then I get exposed to a larger future-facing commodity company with nickel and copper and lithium. So I'd be happy to take that journey, or I'd be happy to stay in Western Areas if it remains an independent company, because it's the only mine in the world today about to deliver a new nickel mine. And the market's only just realising that. That's what that independence tilt has done for the market.
Hey, copper's the other interesting story as we move to decarbonisation. Obviously, there's a lot of infrastructure to be built to achieve that pursuit. Copper and other commodities obviously benefit from that. Are you bullish, bearish copper at the moment, and best plays in the sector?
James, I'm going to be controversial and say I'm bearish at the moment. Why? And I'm not as bullish on the equities because of Evergrande, China property. So I'm very bullish the copper space, very bullish the future-facing commodities angle and that outlook you talked about with infrastructure build-out. Right now, we're going through some indigestion in the copper space. It's the more liquid commodity of the complex, so it always moves faster, higher and lower quicker. And at the moment, we're going through, we've touched the copper price high, and we're just working through what could happen in China. So net of any major issues and contagion, copper price does look attractive at these levels, but we need to ascertain what that risk is to property. So within that context, copper equities, Oz Minerals, my preferred equity, the best producing company in Australia in copper, the best managed company in copper in Australia, one of the best managed mining companies in Australia, but it's not cheap. So against that context of a potentially difficult pricing environment, Oz doesn't look cheap. I'm not chasing that one, but we have other names that look more attractive and a discount to fair value, which are worth looking at once the copper market and that global backdrop stabilizes, potentially literally in the next days and weeks.
Yeah, what Pete's suggesting there, obviously Evergrande is a large Chinese developer. The key is not around that developer going bust or bondholders there losing their shirts there. It's around the driver of Chinese growth over the last decade or so has really been around property. And China, on a more global context, has been a driver of global growth. Tie that back into copper. Copper is this barometer of economic activity, and that's why Pete's a little bit more concerned in the short term around the copper price, which is really understandable until we see what plays out in terms of Evergrande and the ongoing issues with Chinese property. Michael, the speckies in that space that you and Andrew Hines, who's our head of research, cover. Anything you'd like to add there?
We don't cover any speckies, James. It's straight investment grade.
I should stop calling them spec. They are
emerging companies.
Return. They are emerging companies. I apologise, Michael. My sincere apologies.
But I think you're referring to Q-Mines, ticker QML. I suspect. But,
that's the one. That's the one.
Yeah, they've got a 100% interest in the Mount Chalmers project in Queensland. So that's about 20 kilometres inland from Rockhampton. So that was a historic copper gold mine that operated sporadically between about 1900 and 1980. So it's produced 1.2 megatons of ore at 2% copper and 3 to 4 grams a ton gold. And about 2/3 of that is from the open pit, 1/3 underground. So there's currently an inferred resource of about 70 kilotons of copper equivalent. And what the management team at Q-Mines want to do is get that up to sort of 200 kilotons of copper equivalent with some drilling. And that's going to be sort of enough, they think, to restart the mine. So at the moment, it's very exploration focused. And the type of deposit it's a volcanic hosted massive sulfide deposit, so a VHMS, and that they're typically characterized by multiple deposits within a cluster, so close by. So they've got acreage close by to the Mount Chalmers mine, and they're pretty confident, their technical team, that they're going to find more copper close by. And it's sort of, they'll continue infill drilling there. And the drilling results they had yesterday were really good.
Q-Mines in that space is one to look at. I won't let you go on there, Clarky, because we've got a bit more to cover, and I'm conscious of time. I think Clarky only covers things that go up, so we're going to think of things that are more out of favour at the moment. So sorry to lob this on you, Peter, but let's start with iron ore. So it's around around 114, 115 bucks a tonne at the moment. It's been 220 at the highs. It's been a massive deterioration in the iron ore price. Is it done? Is it oversold, or is there more to go? And obviously then the influence on the equities listed in Australia.
James, again, to be provocative and very clear, iron ore price is
I'm sorry, mate.
lower.
I'm sorry.
No, that's fine. So iron ore price will, and again, trend lower from here, to be very clear. But for now, we've probably seen the near-term low. And why? At $100 a tonne, we saw in 1 week 3 Australian junior companies curtail production, which had only started in the last year. Why? Their margin had been compressed in the space of 1 month where they weren't making money. So those marginal producers, very small, like 1 million tonnes per annum each. So in a global market of 1.5 million tonnes, almost insignificant. But there's a bunch of those around the world which have started because the incentivized price drew them into the market. They're starting to drop off. So right now, today, 100 feels like a near-term floor. I call it, we've made a fresh lower low. We'll probably go and make a fresh new high, as in like 120, 130, 140 before you make another low. What happens from here though, James, in the December quarter, supply globally is seasonally the strongest. Australia, Brazil, South Africa, the best weather, the best backdrop, they always deliver the most tons. That's going to be against an environment in China where 2 things happen. 1, seasonally lower demand typically, but also Chinese power constraints mean there isn't the power to run industry. Steelmakers are being curtailed for that reason, but also environmental reasons. And then going into February with the Chinese Olympics, we want clean air. So steelmaking may be at a lower capacity between now and next February. Seasonally stronger supply, prices likely to see supply and demand balance tipped in favour of oversupply. So price may make a fresh new high, like a fresh newer lower high in the near term, but it's ultimately trending lower. And a number in closer to 50 than 100 is where it will balance out at some stage in the next 1, 2, 3 years. Why? Capacity out of West Africa, etc., lower steelmaking out of China, and scrap supply and a bunch of other reasons. But we're on a journey lower, but we've seen the low probably just for now, short term.
So short term, we could get some respite. But how does that filter into your views around the stocks? Obviously, BHP is a stock that you cover. You've still got that on a buy. Fortescue, I think you downgraded recently to a hold and a $15 price target. Correct me if I'm wrong. How does that play into your view on the equities?
James, the best equity to buy right now in iron ore, if you need to buy iron ore, and I don't really think you need to buy iron ore today, but if you do, you'd buy a company called Deterra. Its ticker is DRR. Why? It's got the best growth profile in the iron ore sector, bar none. Over the next 3 to 5 years, it will grow its income stream by 165%. Why? Because that's the BHP mine it gets a royalty from. That's what they're doing. It has no operating risk. It has no OPEX risk. It has no CAPEX risk. It just gets a royalty. So if you need to play iron ore and you want to play with a minimum risk but the most growth, you play it through Deterra. So that means by default, Fortescue is not a must-have right now. Rio Tinto is not a must-have right now. BHP is different, James. It's got copper. It's got nickel. It's got potash coming up. It's got also metallurgical coal, which is a whole separate subset we haven't talked about today. So on balance, I'm still happy to look at BHP, particularly because it's cheap in absolute terms, but it's got a different commodity mix.
And the last earnings, about 70% of the EBITDA was coming from iron ore, and copper was around the 20 from memory, and then less for the other commodities. Obviously, that proportion has been high because the iron ore price, the earnings coming out of iron ore, has really been high. What's the normal mix in BHP in terms of their earnings profile?
Roll 3, 5, 7 years ahead, and we'll get BHP should be 50% iron ore, should be 10, 15% metallurgical coal. It'll be about 20-ish%, 25% copper. Not sure what that adds up to now. And the balance is going to be in nickel, and potash will just start emerging. And over time, potash will be about 10, 15% of BHP. Nickel will max out maybe 5 to 10, and you'll just squeeze that iron ore down as they come in. So it will always be around about 50%.
You get a truer diversified global miner in a bunch of different commodities, not so heavily weighed or skewed to the iron ore price at the moment. What about gold, Pete? So the thesis around gold, around negative real rates, etc., has not really played out over the last 12 months. Gold prices have been pretty subdued. Gold equities have been plumbing 52-week lows. Is everyone going to the crypto, and that's why we're not buying gold as a hedge, or what should we be doing with the gold equities at this stage?
2 observations up front, James. Gold price is cheap in absolute terms, as you mentioned. I can talk through that. Secondly, gold equities are the cheapest equity sector in the metals and mining and energy sectors at the moment. So if you wanted to buy the best value, buy gold. Needs a tailwind. What's that tailwind? Gold price. But I said gold price is the cheapest in terms of absolute terms. Real rates are key in the short term. They have dislocated between that typical correlation between real rates and gold price. That dislocated in June, on June 16, when the Fed, the FOMC, or the Central Bank of America, started talking about tapering of their monetary policy. That saw that divergence. But in the last 5 days, the backdrop has been more constructive. China dialing back mining of cryptocurrency has been a bit of a reality check to what's happening in the crypto space, that it's manufactured, it's not mined, and it's not a store of wealth necessarily. But we've also had that real rates view, and overnight, inflation hit the highest level in a year, and it's potentially on the highest level in a decade. So we've got that inflationary factor bubbling as well. We've got some geopolitical issues globally driven by what's happening in energy, Mike talked about, and inflation's not going away anytime soon, albeit as the chairman of the Federal Reserve talks about it being transitory, but it's going to be here for a while.
So gold equities in the gold space, what do you like here? What are you going out there and buying?
The cheapest two gold equities at the larger end are St Barbara and Regis. The one I like is Regis. It's trading at about 0.6 times its fair value, so it's cheap. It's got a well-funded balance sheet. It's got a growth pipeline which is sector leading. So between now and 2025-26, it will grow annually its production by about 13%. Its peer group's about 6%, which is still very large in the context of the history of the gold sector. So that'd be my standout pick. At the bigger end of the market, so a Newcrest versus a Northern Star versus Evolution, it's kind of like any or all of those deliver the same outcome. So it depends on whether you want size and longer dated growth, which is Newcrest, or you want near-term growth out of Northern Star, which is very well mapped out, or Evolution, which is very similar. But the cheapest one, and the one I'd highlight, would be Regis at the mid-cap end, and probably I'd say Northern Star / Newcrest at the bigger end. But it's kind of almost any or all.
All right, I'm gonna wrap it up in terms of the discussion now. We'll move on to questions. I've got about 20 questions that were sent in, and there's another bunch of 15 or so on the line there. So just in terms of wrapping this up, I think one of the keys for investors moving forward is the commodity space is really happening at the moment. We've been big proponents of investing towards commodities over the past 12 months. They feature right across our portfolios. We've lent on the resources from an analytical perspective of both Peter O'Connor and Michael Clark here at Shaw. We've got a pretty good resource coverage here. Market Matters is obviously writes a daily note around these and drawing on these ideas, and that's an area we're going to continue to focus on in the next in the next 2 months. In the next 12 months and beyond. I was on a call last week with a well-known hedge fund manager here in Australia who's talking about the commodity super cycle, that there's so many tailwinds for commodities moving forward as we move towards decarbonisation, and the like, that it's an area that you must have a finger on the pulse. You must have an understanding of the nuances within the sector and being in the right stocks that are exposed to that big changing dynamic that we're seeing globally. So I just want to quickly go on and run through some of the questions for the guys. What's going on with Whitehaven today? Company sales are down 14. Whitehaven, you can speak to this, Pete, but it was down 7% today. Coal prices came back last night.
So James, to your earlier question, so I mentioned the backdrop. Coal price is up 5 times in 1 year, but over in the last 2 days, it was up 15% the day before, and it was down 13% overnight. So it basically gave back. So that spike, and they're not good spikes to have in commodities. It's telling you how squeezy the commodity market is, and it's a similar thing happened in LNG pricing as well. But the underlying price around that $200 level, we think that plateau price will remain. But so the rise yesterday of Whitehaven and steam coal price was given back today. So I think it's across the sector. But over the this quarter, December quarter into the first quarter next year with the northern winter, you'll see prices for all energy commodities remain at a plateau, which is well above their long-term averages.
What's your take on Yancoal? I know you don't. I know we don't cover it because it's it's dominated by Chinese ownership, but they've done pretty well as well.
James, I know well. I've been following the company as it is, and also the assets that it's got for 30 years. But it's the same. It's whether it's a Whitehaven, a New Hope, or a Coronado. Yancoal is very similar in nature to Whitehaven. It's a larger Whitehaven, so it has a mix of both thermal coal for energy, but also metallurgical coal for steelmaking, a similar quality. So think of it as a bigger version. But the key is, James, it is the most leveraged company in the world in mining. It's got about $4 billion of debt versus its market cap. So it's a huge deleveraging story. So a huge risk. And can I use the term, Yancoal is a lobster pot. Okay, so it's very easy to get into, and I encourage you with this thematic to buy it, but be very aware, if you buy it, you must be very clear about what your exit strategy is, because if you don't, it will be the lobster pot, which will be there for the next cycle. So Same thematic, same story, very, very levered. So it's a deleveraging story, but beware. Easy to get into, hard to get out of.
Hard to get out. I love the lobster pot analogy there, Pete. Use it all the time. Paladin Clarkey. So Langer Heinrich's got, I've got a question here. They're saying we'll take nearly 2 years to get the mine back into production. Is it investable currently? Is the question.
Oh, I think it is. I mean, you just got to
Short
take your
answer
view.
is yes.
Yeah, you just got to take your view on when, how far out you're comfortable from cash flow, and the cycle. There's a lot of tailwinds in the sector. I think it's a bit sooner than that. 2 years sounds. It's more like 12 months from when they pull the trigger and have their contracts in place and sort of say final investment decision. And another caveat, Paladin, I don't think they're going to need to raise equity to restart Langer Heinrich now. I think they'll do it via debt, project finance type vehicle. So you're not going to get any dilution there as well. So I think I'm comfortable owning Paladin. Like everything in a rising commodity price environment, everyone is going to do well. And Paladin has got the best balance sheet in the sector, and they've got the best asset in the sector. Like Langer Heinrich's going to produce 6 million pounds of uranium. So that's getting towards sort of 4% of global supply. So, and they're looking for growth as well at the moment, Paladin. So that story I think is going to continue to grow.
We've got a question here on CXL, which is Calix. Do we cover CXL? We certainly do. The analysts here don't cover it. We've got Aidan Bradley who covers CXL. Calix, really interesting business. We actually hold it in our the Market Matters emerging companies portfolio. We think it will do well from here. Jackie's asking whether Sandfire, Pete, is a good investment at this point in time. Obviously, they're making a pretty large acquisition.
Short answer, yes. So absolutely, categorically, yes. Why? I'll come back to the details about why, but in terms of the copper comment I made earlier, I said copper is not enthusing me as much in the short term, and that's absolutely right. That's part of where it's trading, but I see that as an opportunity for Sandfire. It's now trading, it's as cheap as the gold stocks I cover, so it's trading about 0.65 times its fair value. It recently announced a very large acquisition, more than doubled its both production and market capitalization, a large equity offering. What's holding it back at the moment is some of those headwinds out of China, James, you mentioned very articulately before, but also the retail overhang. Given the pricing of the retail offering is $5.40, the stock is trading, I think, about $5.14 today. It's cheaper to buy on the market than buy the retail offering. That retail offering is 50% underwritten by a major Australian shareholder called Australian Super, so they're very sticky and they'll hold that. But the balance is underwritten by one of the underwriters, a bank, and they'll probably flip the stock at some point. So that's seen as an overhang. So I would be a buyer, not of the entitlement, but on market. And it's got one of the best growth pathways of the copper sector. And it's, whereas Oz Minerals is trading a substantial premium to fair value, this is at a substantial discount to fair value.
Are you concerned about the price they paid for the acquisition they made? Obviously, a pretty competitive environment for copper assets.
Think of a housing auction, James. If there's two bidders, it's contestable, and there's three, it's even more so. So it was a contested offering, so it was never going to be a cheap price. So it was fair value at best. How to make that look more attractive is adding more resource to the portfolio. So it has a 32 million tonne copper reserve in Spain, the asset they bought, but it has 122 million tonne resource. As they convert some of that resource into reserve, it extends the life. Every year they extend the life beyond 12 is very valuation accretive. So the current reserve life is 7. They will definitely get to 12 and they'll likely get to 20. But it's like every gold mine in Western Australia, James. They've all got 5 years life. That was a story 30 years ago. They've still got 5 years life. So not every asset has a finite capability to continue to deliver new tonnes or new ounces. But in this case, it's a very well-defined structure in a very clear mineral province. They will be there for several decades, if not more. So I think you'll find it will be seen as a cheap price. But right now, those who want to be trying to talk it down, they're saying it's got a short life, they pay too much. But it's actually got a longer life and they paid a fair value at the most.
All right, Grace is just asking about a lithium company. We like PLS, ORE, IGO, I presume you're talking about. We actually bought PLS yesterday in the Market Matters Emerging Companies portfolio. We own IGO. There's another question from Nick around Strandline STA, where there's a large overhang from the recent capital raising. The guys here don't cover this. This is covered by one of our other analysts, Andrew Hines, who's just upgraded his price target for it. Mineral sands market is really strong. I know Pete covers. Pete's got some really positive views on the mineral sands market. This is obviously a smaller, more emerging company, Clarkey, I'll say, rather than a speculative one, that have got some construction risk as they ramp up. But mineral sands, just quickly, Pete.
James, mineral sands is, and can I introduce a concept here, which is we need to be looking at supply-constrained commodities as the key driver at the moment. So we've been through that demand thrust of the last 12, 15, 18 months. Now it's about trying to identify those nuances you mentioned, and this is about supply. So mineral sands is one of those supply-constrained industries. Two key commodities, one's called zircon, which goes into the tile market, the other called titanium dioxide, which goes into pigment marking, think painting a house. So what have we done a lot of over the last year? We've all been at home, we've been renovating, painting, tiling, kitchens, etc. So that's pulled through demand, but there's a shortfall of supply. And this is not just about incentivizing price, there's just an absence of new capacity globally. So it's a very clear tale where there's no major new supply coming on several years out. So we've got this demand pull, supply squeeze at the moment, squeezing prices higher into 2022, potentially into the start of 23. And it's a very, and I use this word very rarely, but a structural story where it's hard to identify where new supply will come from. So we could be in a period of elevated pricing for not just a couple of quarters, potentially a couple of years. That'll drive the likes of Strandline, who commissions the end of 22, or Aluka, which is an existing producer and number 2 in the world in mineral sands and number 1 in zircon. So different ways to play from the different ends.
All right, guys, I'm conscious of time, so I'm going to wrap it up there. For those, there's a few questions just around tickers for stocks that we've spoken about. We will endeavour to cover a lot of those in the Market Matters report, so members will be able to get access to all of the discussions that we've had from today's webinar. If you're not a member, you should be one, so go and sign up. I'll leave it there by saying thank you very much to Peter O'Connor, who's Senior Analyst at Shaw & Partners. Always great to get your views. Sorry I gave you a hard time today, Rocky, but I love you being on these webinars, love doing videos with you, so all the best, mate. And Michael Clark, first one following off the Market Matters deep dive. You've been great, really appreciate your insight, and I'll be sure to get you on again, so thank you very much.
Thanks, James. Pleasure being here.
And thank you all the listeners of this webinar. We had a huge attendance at this webinar. It's obviously a very topical area and a lot of interest in there. So thank you all for joining us, and we'll have another one soon. Bye for now.